Hey folks, welcome to the Rate Update with Dan Frio. I am Dan Frio. This video that I'm just presenting to you is answering a lot of questions that we all have in the real estate business. What's 2021 going to look like? So I tried my best to put together as much information as I can to detail to you guys. I don't expect a housing crash, and I think home affordability is right around the corner for you. So please watch the video, and at the end I'll show you how to get in touch with me so I can help you on your way to home ownership. Stay tuned.
Welcome to another Presentation Expressway. This is our housing and interest rate outlook and forecast for 2021. Now, we had to delay this a little bit and kind of go back to the drawing board because there were some changes that took place regarding the Senate elections in Georgia, and that kind of made us rethink things just a little bit. But we'll talk about that in this interest rate outlook and housing outlook for 2021. So here we go. Well, she's back, and that's Janet Yellen. She might not have been the greatest Fed chair, so let's give her a shot at Treasury Secretary. Now, the Treasury Secretary gets to sign all the money. That's right. Her signature will be on all of the money that gets printed, so you'll be seeing a lot more of Janet Yellen's name right here. Now, Janet Yellen never met a spending program she didn't like, and she's very different than the current Treasury Secretary or the outgoing Treasury Secretary, Steven Mnuchin. And Steven Mnuchin is someone who butted heads a little bit with the current Fed chair, Jerome Powell. Now, Jerome Powell really believes that the Fed should be involved in just about everything. Now, we do receive some benefit from that because a lot of the Fed buying of mortgage-backed securities is helping to keep interest rates low. But Jerome Powell really has been so aggressive that he's actually been buying bonds of things like McDonald's and Apple. Do we really think that Apple is in dire straits and needs the Fed to be buying their bonds? I don't know. It's questionable. Steven Mnuchin, the current Treasury Secretary or the outgoing Treasury Secretary, seems to think that and would butt heads with Jerome Powell. But with Janet Yellen there, well, it's going to be green lights for everything, and she's going to be egging him on, saying he's not doing enough. So who knows what's in store for the Fed? But I'll tell you this, you can see a direct correlation from the day that Janet Yellen was appointed to the rise in gold prices, the rise in silver prices, and the enormous rise in Bitcoin. Why? Because it is believed that what they will do is debase the currency, make it worth less. And by doing so, fixed assets like gold, silver, and Bitcoin, which are not fiat currency, they are fixed and finite, those currencies are gaining in value. Now, with anything else, is it a bit overdone? Perhaps. We don't know. But we do know that by the dollar losing value, and the dollar has really sank, that does tend to potentially import things like inflation because now things cost more to bring over. And the bond market not liking that very much, at least to start the year. Additionally, the spending programs, now especially with a blue wave, means that additional spending could bring some additional inflation. Now, the Fed will still be at zero. And they're going to be at zero for a long time on the Fed funds rate. But as you've seen, interest rates on mortgages can rise even with the Fed at zero. But our clients don't necessarily understand that. They hear the Fed's at zero and they can't necessarily understand why mortgage rates might be going up. Well, here's a long-term chart here for the past, let's say, 40 years of the blue line, which is mortgage rates, and the red line, which is the Fed funds rate. Now, over a 40-year period, they are trending in a similar direction, of course. But our clients don't have a 40-year period to lock in a loan. How long do they have to lock in their loan? Who knows? 30, 45-day period to choose when they're going to pick their loan. And as you can see here by this chart, there are many times when the Fed has raised rates, but at that same time, mortgage rates go down. Or there are times when the Fed lowers rates and mortgage rates go up. And this happens again and again and again. But let's take a look at when the Fed was last at zero. That was between 2009 and 2016. So just about a 7-year stretch where the Fed remained at zero. But during that period of time, mortgage rates had a couple of 4-month stretches where they went up rather significantly. One was when they went from 4 to 5 1/8. Another, 3.5 to 4.75. Now, those are pretty big moves in a short period of time. I'm not suggesting that we see that exact type of a move once again here, but we can't rule out that mortgage rates can go up. And I think it's very helpful for clients to see something like this and realtors to see something like this, because there will be times when mortgage rates do rise, even when the Fed's at zero, and clients shouldn't be lulled to sleep or shocked when they do and question your authority as that you're out of line because rates that you're quoting have gone up while the Fed's saying that's zero. This could be very helpful for you to share with them. Now, I did mention debt. And when we have debt, a lot of people are forecasting interest rates to rise because of that. And we've seen an effect on interest rates in the short term on these announcements of stimulus rise. But that tends to wear off, and then the debt takes over because we are not printing money. People use the term printing money. We're not. We're issuing debt via treasuries. And initially, what that money that's used for stimulus does is create economic activity and some inflation. But after the effect of that wears off, debt takes over and you have to make the payments on that debt, which leaves less money to generate economic activity, and it slows growth. Every place in history at every period of time, and the United States is certainly no exception, as debt rises, interest rates decrease. They don't increase, they decrease as debt rises. And this has happened in France, in Japan, in the UK, in Italy. It's happened all throughout the Eurozone, all throughout Asia, and certainly here in the United States. As debt increases, interest rates decline, they do not rise. Now, there's an initial spurt where the debt, when you take it on, that stimulus causes economic activity. Think about a family who just went into debt to purchase a vehicle. Well, the initial purchase of that vehicle creates some economic activity because the manufacturer makes a little money, the dealership makes a little money, the salesperson makes a little money, and that economic activity generates some inflationary pressure potentially, but it wears off. And what remains for many years is the monthly payment on that debt, which then acts to slow the velocity of money, to slow growth, and drags the economy down. And that's the same thing that's happening with governments. Now, we believe rates will remain low, but inflation will be pressured lower by the debt, as we mentioned, and technology. The labor force will also be hopefully in a position to come back because there's a little over 10 million people that are out of the workforce. As these jobs, God willing, start coming back, it will alleviate some supply chain constraints, and it will actually make things better and cheaper because there wouldn't be as much of a constraint on creating supply, and that will actually help alleviate inflation and reduce prices. Additional spending on the new administration will increase the supply of treasuries to be sold. Rates will likely bump higher before resuming a downtrend, and we're kind of experiencing that bump higher now. But while everybody else is out there predicting much higher rates for the rest of the year, we are seeing rates actually come down again because of the debt and because of technology reducing inflationary pressures. Now, when we take a look at housing, housing has been hot. And boy, so many people have been wrong for so long on housing. Fortunately, we've been on the right side of this, and we're amongst the first to call for it, and have been saying that housing is going to remain hot, and it's going to continue. And one of the main reasons is the demand. The median age of a first-time home buyer is 33 years old. That means they were born right here. This shows you how many people are born every single year. And what we're about to experience is, from what happened 33 years ago, was an explosion in births. So over the next 3 years, this explosion in births will carry forth into an explosion in first-time home buyers. So if you thought the demand was high now, over the next 3 years, and by the way, the level of births never goes below this into the future, where first-time home buyers are. So you're always going to see more first-time home buyers coming to the market. You will see a huge increase in the amount of demand. Now, at the same time, supply has been extremely tight, and new construction is not keeping up with that demand. It was already short, but because of COVID, it took a huge chunk out of production. If you want to know why inventory is so tight, one of the main contributors is because builders didn't put anything on the market for 6 months. And because of that, we were already in a position, of course, where inventory was tight. But because of this now decrease in supply, on top of that, to exacerbate it, inventory is exceptionally tight, and there are much more people wanting to buy homes, demanding homes, than the supply is there, and that has caused prices to rise, homes to sell quickly, and it's not going to go away anytime soon, even though home prices have gone up. Now, when you take a look at vacancies, vacancies are also near record lows. And why is that important? Because if you have homes that are vacant, the seller is carrying the cost for that, not getting anything because it's vacant. So they're in a position to be saying, hey, you know what? I'm carrying this thing for X amount of dollars every month. Maybe I'll just reduce the price and get rid of it because I'm paying so much every month. But with vacancies at historic lows, there's no incentive for sellers to drop prices. And we mentioned inventory being low. Well, goodness gracious, look at this. Inventory levels are dramatically below any period of time we've ever seen. The people who talk about housing bubble or housing problems, I mean, this was a housing bubble. Look at how high inventory was. In the mid-'80s, here we go. And 2007, 2008, inventory is so much higher. Our population has increased, by the way. And with our population increasing, we see inventory at a historically low, the lowest ever. Is this a good time to buy? Well, yes, it is. Interest rates will remain very favorable. In addition to that, high demand and tight supply point to about 6% appreciation on real estate in 2021. Let's remember, if somebody bought a home and put 10% down, well, 6% appreciation on that home equals a 60% level of return on their investment or down payment.
So I hope you found that video informative. If you want to reach out to us and just to dig in a little deeper in trying to get pre-approved for a home, if you're buying, building, or even refinancing, here's the best way to reach us. Just go to therateupdate.com. It'll take you to my website. Down here below is give you an 800 number on how to reach us. It's 844-775-5626. You can find us all over social media. If you want to reach out to me directly, you can email me at D for Dan Frio, which is Frio, at preferredrate.com. But if you want to get the process started, here's the best way to get pre-approved to buy a home is this tab right here. If you're looking to refinance, use this tool right here. What this does is it takes you down a path and it asks you specific questions, and based on those answers, it provides me the information I need to fit you into the right program at the right time. Other than that, I hope you find this video or all my videos informative. Please, all I ask to do is give me a thumbs up, subscribe down below, click the bell so every time I do post a video, you get an alert. And by doing all of that, it also helps me, helps the algorithms on YouTube help promote me higher in the rankings so I can help more and more people. Other than that, God bless. Have a great day. Hope to hear from you soon. Bye-bye.